Our classroom stock portfolio now has an annual return of 20.55%. The portfolio has broken the $2,000 level and is now worth $2,056.35 after 125 weeks. Hi, Professor Rex here. We're now a little over 2 years into our class project where we invest a total of only $12.50 per week and split it up by 10 different dividend-paying stocks. Stocks cooled off a bit this week, which is not unexpected since the May to October timeframe tends to see gains that are not quite as good as the November to April timeframe. And as always, we need to keep reality in mind after particularly hot or cold market action. And the reality is stocks historically average 10% per year. So in other words, over the long run, we will not be able to maintain our 20% annual returns. Also this week, my students and I had a big debate on Nvidia about if it's a dividend growth stock or not. And I disagree with most of my students. We also had the annual debate my students and I have, that being stock splits and if they are an indicator of future stock performance. More on that later. Back to the historical return of the stock market over the summer. According to the Center for Financial Research and Analysis, since 1990, the S&P 500 gained an average of 1.1% from Memorial Day to Labor Day. The NASDAQ 100 mid-cap and small-cap stocks beat the large-cap benchmark, while the value group typically declined. The healthcare, real estate, and technology sectors recorded above-average gains, while communication services, energy, and materials posted the poorest performances. Of course, we don't try to time the market. We just keep on plugging away each week, investing our money into those 10 different dividend-paying stocks. Now, if you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting a little over 2 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is going. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. Now, there are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. In 2022, the year we started the portfolio, the market did not perform well, but because I don't believe in trying to time the market, as I mentioned before, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,056. The portfolio's return has been 20.55% per year, which is higher than the S&P 500. Last year, the portfolio's return was 28.6%, which also beat the S&P 500, and in the preceding year, the portfolio once again beat the market. So, why do we only invest in dividend-paying stocks in this portfolio? That's explained on the next slide. The first reason we stick with dividend-paying stocks is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, the average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year. So go check out the source link that I included at the bottom of the screen. Maybe more importantly, historically dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study has showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why a classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you're married and filing separately. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses, but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal taxes on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $61,625. Those amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for the long-term capital gain, and then add that to the standard deduction, which is found in IRS Publication 505. As you can see in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. And then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate in income from qualified dividends that would be federally tax-free. So why do we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? The next slide explains that. The main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member in the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once a year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation each year. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. Now for a classroom stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week because of inflation. In year 3, inflation wasn't quite as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. A very popular exchange-traded fund that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker SCHD. So SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio's value is over $2,056. If we had instead invested the same exact amounts into SCHD on the same days, the portfolio's value would only be $1,751, a difference of 17.4%. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has, at times, had large positions in stocks that I consider to be value traps. This slide shows our best performing stocks based on when they were initially purchased. Stocks in yellow have been sold. Lam Research this week announced that they will be splitting their stock 10-to-1 on October 2nd, and this got investors excited, pushing the stock price up and putting Lam Research back on top of our performance board. Broadcom, a chip-making company, also moved up this week, but not enough to keep its #1 position. Broadcom has provided us a total return of 153.5% in 24.9 months. The stock with the biggest move in a short time is still boring cereal maker WK Kellogg, which has provided a total return that is not boring of 71.7% in 6.1 months. And that's after cooling off a bit this week. Intuit, the maker of TurboTax and QuickBooks, just barely missed the list, coming in at 16 with a total return of 62.9%. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called Dividend-Growth stocks. So most of our investments made in this portfolio were made in these stocks, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. About 10% of the other investments so far have been invested in smaller, under-the-radar companies, usually they're smaller, that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. Examples of those are F&G annuities from this slide and Repositrack, as well as Crane Holdings and Finia. Before we look at the 10 stocks we bought this week, here are the 10 stocks we bought a year ago, along with their total returns, which of course includes dividends. Crane Holdings, one of our under-the-radar dividend payers, is the best performer so far, providing a total return of 99.2% so far. And now remember, that's based on the initial purchase into Crane Holdings. I still own all the stocks except the stocks in yellow. Most of these stocks were purchased over multiple weeks, which is why many have appeared in recent videos, but this slide only refers to the investments made a year ago. And so in yellow, we sold Robert Half to generate additional funds to invest in another company because it seemed to be fairly valued at the time. And we sold Fidelity National Information Services because they cut their dividend. This particular purchase of Fidelity returned 22% in less than a year, despite the dividend cut. The average return of the 10 stocks we bought a year ago is 40%, despite 2 stocks not being held the full year. The annualized return for all 10 stocks is 42.8%. Crazy high. Again, don't expect that to continue in the future. Obviously, our purchases won't continue this high rate of return, but it's a nice start for the portfolio. Now, on to stocks we purchased this week. So, as I mentioned, most of our stocks for this portfolio are comprised of high-quality dividend growth stocks, but the other 10% is invested in under-the-radar dividend payers. And now we come to Nvidia. This week, the company posted quarterly results that were even better than the already high expectations. The company also announced it will raise its dividend a whopping 150% and will split the stock 10-1 on June 10th. Now, my students, many of whom are gamers and love NVIDIA's products, and I'm a gamer and I also always have NVIDIA graphics cards for my computers, have been trying to get me to buy the company for our portfolio. In the past, prior to this announced dividend increase, I argued that NVIDIA has not raised their dividend on a consistent basis enough to be considered a dividend growth stock, and the company has not recently initiated a dividend, therefore doesn't really qualify as an under-the-radar dividend payer by our definition. And I argued that the minuscule dividend, while nice, is more of a symbolic gesture rather than a substantial income source. Then my students argue that NVIDIA is a great growth stock, which is true. Something I agree with, as you can see in the Forbes interview I did where I recommend the stock in 2017. I'll include the link to the interview in the video description. On a split-adjusted basis, according to Yahoo Finance, NVIDIA's total return since I recommended it has been 1,912%. And NVIDIA is also personally my third largest individual stock holding, so I do believe in the company's future, but I still contend it's not a dividend growth stock until it consistently increases its dividends, which I argue it won't, since it can instead reinvest those funds into its business and continue to get a great return on its investment. Finally, my students argue that NVIDIA's free cash flow per share is growing substantially, as you can see on the graph on the right side of the slide. It shows NVIDIA's free cash flow per share for the most recent quarter, showing that's on trend to theoretically eventually being able to be a stock that could consistently raise its dividend. By the way, the definition of free cash flow is the cash the company has after it pays its bills and pays for any planned investments. It's the cash that the company is free to spend on whatever it chooses. But I still don't think it's going to become a dividend growth stock. So, who won the argument? Well, because we have several stocks in our portfolio that appear to be fully valued, I relented and agreed to selling those stocks and reinvesting the funds in Nvidia this week. It's only a small position of the portfolio at 1.76%, and I do not envision regular investments into it, and will classify as a capital appreciation strategy, since I highly doubt it will consistently raise its dividend in the future. Now let's talk about stock splits. Throughout my years of teaching, stock splits is one investment topic that always gets my students excited, and I try telling them that long-term studies show that buying a stock after it has announced it will split its stock has not produced above average returns. Invariably, my students will point to a recent stock or two that has split its stock and then experiences substantial price appreciation anyway, but that's just a small sample size. Now, maybe things have changed in the market in recent years, so if any of our viewers can point us to a current study on the effects of stock splits, share them with us. We'd love to check it out. Now let's look at the stocks we sold this week. We don't often sell stocks, but this week we sold 4. All 4 of them were because they appear to be fairly valued. The average total return from their initial purchase was 18.5%, and the annualized total return was 20%. Tractor Supply provided the best total return at 40.9% in only 7 months, while Humana was the only clunker with a loss of 25%. Now let's talk about the dividend growth stocks we bought this week. Here are my ratings for the top 12 dividend-paying stocks this week. They are Comcast, Visa, Allegiant, Masco, Nike, Microsoft, Northrop Grumman, Cigna, Chevron, Lockheed Martin, Huntington Ingalls, and Skyworks. We purchased this 10 stocks that are not in the yellow highlight. The stocks in yellow have already grown to be 4% or more of our portfolio, so we did not invest more in them this week because we wanted to build a more diversified, less risky portfolio. Remember, each week we buy 10 stocks, and since we are investing such small amounts in each stock, it means we are buying fractional shares in our Fidelity brokerage account. This table includes their industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The 3 most undervalued stocks this week appear to be Comcast, Allegiant, and Skyworks. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they are likely to continue to raise dividends. Therefore, this is a dividend growth strategy. Now on this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for most of our purchases. The other 10% or so have been invested in those smaller, under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown that they historically beat the market averages by a significant amount. Other than Nvidia, all the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a long history of raising the dividends that they pay to their shareholders. Now, we also believe that Nvidia is a high quality stock. It's just probably not a dividend growth stock. Risk is the first quality component on this slide, which is mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings, also called profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Microsoft, Nike, and Huntington Ingalls Industries. Remember that the risk ratings are comparing these stocks to other stocks, not to other investments like bonds or CDs. And the companies earning the highest financial health ratings are Visa and Microsoft. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Comcast, Nike, Chevron, and Skyworks. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade, dividend growth potential, the companies in the best position to increase their dividends substantially are Comcast, Visa, and Microsoft. The companies with the best combination of recent dividend increases and potential of future dividend increases are Comcast and Visa. On this slide, we're looking at stocks in our portfolio that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying stocks raise their dividends about 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. This week, along with Nvidia's 150% dividend increase, Nicollet Bank shares, a tiny under-the-radar dividend payer in our portfolio, increases dividend by a healthy 12%, while Medtronic also raises its dividend, but only by 1.4%. Medtronic's current dividend yield, by the way, is currently 3.4%. Ideally, we want our companies to raise their dividends higher than 3%, which, as I mentioned, is the historical average of inflation. The last 17 dividend increases for the portfolio have an average of 17.5%. This slide shows stocks in our portfolio that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and the dividends per share that we received once the stock split has occurred. And as you can see, Nvidia will be splitting their stock in June, and Lam Research will be splitting the stock in October. And the ratios are 10 to 1. So for every 1 share of Nvidia you will now have 10. Of course, the price will get adjusted also, and it will be adjusted downwards. Here's a look at the 10 stocks that make up the largest portion of the portfolio as of Sunday. Now, this is our dividend growth portfolio. This week, for the first time, Microsoft moves to the top, followed by American Express, and then Schwab. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invested in just the top 10, regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated and more volatile portfolio. And many investors cannot psychologically stick with a volatile portfolio, especially during a bear market. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are at 95. That might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. Students asked to start a portfolio using a strategy featuring stocks with higher yields. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. Currently, the portfolio's dividend yield is 4.32%, but the companies in it won't grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, it has a different goal. Therefore, this portfolio would be more geared toward investors closer to retirement. The average investment in this portfolio has provided a total return of 12.7% with an average holding period so far of 139 days. which is an annualized return of 36.9% using Excel's rate function. I need to emphasize that this portfolio has been around for less than a year, and there's no way it can keep up that annualized return since stocks historically average 9 to 10% a year. So while the portfolio has been around since August of last year, the average investment in the portfolio has been held an average of 139 days. For example, the investments we made last week have only been held for 7 days, so that brings down the average holding period. On the next slide, we'll look at the high yield dividend-paying stocks we bought this week. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. Strategy 1 emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close to retirement. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we'll take $12.50 and split it up between the 8 stocks. So each stock gets a 1/8 weighting. Having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8 weighting, which is 1/4, equivalent to 25% of that week's investment. Both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. So the 4 high yield stocks we bought this week while implementing strategy 1 are Chevron, Interpublic Group, Gilead, and Pfizer. And the 4 high yield stocks we bought this week while implementing strategy 2 are Chevron, Evergy, Papa John's, and CVS Health. This week's purchases have an average yield of 4.43%, with Pfizer coming in at the highest with a 5.9% dividend yield. And here's a look at our ratings for competitive advantages, management, and financial health. And on this slide, we can see their grade for recent dividend growth and current yield, as well as recent dividend growth history. In the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. YouTube viewers have asked for more details about the technology stock portfolio that we've mentioned before. So I created this slide. And because my students love technology stocks, on January 1st this year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We're sticking with the original $1,000 investment. The tech themes we built this portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. So far, the portfolio has increased 17.24% in less than 6 months. In comparison, technology ETF with the ticker XLK is up 11.98% over the same time period. Best performers so far are Nvidia at 121%, Pure Storage at 75%, CrowdStrike 43%, Meta, also called Facebook, up 39%, and SAP up 30%. Now, many of my students are extremely interested in tech stocks, like I mentioned, and requested that we rank them separate from the dividend-paying stocks each week, even if the tech company does not pay a dividend. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. So here's our top 10 technology sector stocks. I'll also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks, because many tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. But we use a valuation methodology we discuss in class that can be used on all large stocks, whether they pay a dividend or not. The top 4 tech stocks this week, according to our system, are Adobe, NICE, Accenture, and Workday. So in the comments, let me know if you have any questions or if you want to know about any of the other portfolios more in depth. Also, let me know what kind of other investing videos you'd like to see. And finally, here are the places you can reach me. YouTube, obviously, as well as X and LinkedIn, and my website, beatthestockmarket.com. Have a great holiday weekend, and we'll talk to you next week.